welcome to today's webinar. This is obviously the second in the series of financial tips for business owners. I'm Lisa Conway-Hughes and I've got Faye Watts here, who is a partner at Fuse, a firm of accountants, but she's also a business coach. So to start with, for those of you who don't know me, I run LCH Wealth, and online I'm also Miss Lolly, so I blog and talk about anything to do with money. This is our team. We're a reasonably new IFA business. We've just gone past the year mark now, but I have been doing this for 15 years before. I'm a chartered financial advisor, fellow of the PFS, and you'll regularly see me in female press usually talking about money. I'll hand over to you, Faye.
Thank you. Hello, everybody. My name is Faye Watts. I am the tax partner and founder of Fuse Accountants. I've been doing tax for too long, 25 years or something like that and beyond. I'm also a strategic business coach and advisor. I'm also the founder of, or co-founder of Order Online as well. And I'm a trustee at 𝗙𝗵𝗵𝗹 UK, which is a children's cancer charity where we raise money for research. So I like to be involved in lots of different things.
Keep yourself busy.
Yeah.
And so just first today, this is our disclaimer, it's our small print, but essentially today is just information only. It's there to get the cogs going for you to think about what you want to do in your business. This is just definitely not advice, but we can give you advice as a follow-up if you need it as well. So a quick recap from what we did last week, well, not last week, sorry, on the last webinar. We talked about really honing in on your goals and separating them into that short, medium and long term. Short being anything less than 5 years, and long term usually being 15 to 20 years away. And then we also talked about the times 25, which is whatever it is that you need or you think you need to live a life without your business, i.e. retire, you need 25 times that amount. So if you want £10,000 a year, you're going to need £250,000 in the pot. And just a reminder that all short-term goals want to be fed by cash or cash-like things. We don't want to be taking risk with that money. We also talked about the power of making confident decisions. So Faye talked us through how to get to that phase where you're actually unconsciously competent at everything that you do, and then passing on the other tasks to people who are unconsciously competent, at the things that you're perhaps not. We talked about money systems and some examples of some money systems so that you can automate your finances, so that they're helping you to run the business rather than the money necessarily driving every business decision that you do. And lastly, we were looking at goal alignment. So the goals that you set is the work that you're doing aligned with those goals and that you're on track to achieve those goals. And then we started to think about this big, hairy, audacious goal, what it could be, what it would look like, why we would be doing it. And that's where we're going to pick up from today to talk about those goals. So I'll hand over to you, Faye.
Yes. I think a really big wake-up call, for me, it took me back a moment, is just to remind myself that 25 times. And when you even when you feel like, yeah, you're building the pot, you just realise it's just not enough in that, how much you need to have in the pot to get the income that you want. Anyway, so just talking about your big, hairy, audacious goal, it's that goal that really gets your stomach excited. It's the one that you kind of go, I really, really want that. Now, it's big, of course. We're not just talking about I want to, book a holiday next year. It's a bigger goal. It's that thing that's really driving you. It's hairy because it's just, it's a little bit it's a bit audacious. It's a bit scary as well. And ultimately, it's something you want to achieve. Now, that could be a short or long-term goal. It could be something you want to achieve in the next 5 years. It could be a long-term, big, hairy, audacious goal. But I just want you to just take a minute and just think about your big, hairy, audacious goal, and ask yourself a question: Is it big enough? Is it hairy enough? Is it audacious enough? And is it actually a goal? And just write a few things down. If you've got a pen and paper here today, just write down what comes to mind, and then as I work you through, you might find that you expand on that, or you might just go, I already know it, I'm really clear. But it might be that you want to sell your business for £1 million, for example, just because you can. Is it a goal? Is that something you want to drive for? It might be that you want to build a lifestyle, or sort of it's about building something that doesn't mean you don't have to work stupid hours beyond 55, 60, whatever. You don't want to work weekends, you don't want to work, you want to sort of retire at an earlier age. It may be for greater good, it may be for family, for legacy, for what you might be able to give to charity. It might be just putting yourself out there and doing some great stuff. But what I want you to do is just think about what's beyond that. If you want to sell a business for £1 million, why? What is that for? What do you want from it? What do you want to get that? If you sell the business, what's your outcome? Is it because you want to have a nice house in the country? Do you want to put your kids through private school? What is it that you want to do? What is that pot of gold beyond that? And it needs to be something that inspires you. And for some people, that is simply something like a legacy. For some, it is that sort of lifestyle and sort of being able to retire early. But just ask yourself, just keep asking that question, what you want from your goal. If we move on from that.
Somebody just asked if we could get a copy of the first webinar's recording. So yeah, we recorded it, and I just put in the chat Natalie's email address. So if you just email Natalie, she'll be able to email you one over.
So this is really just to think about what also inspires you. So you think about somebody else you may have met. If you're not quite there, if you're not motivated, have you read something recently? I mean, Lisa shared the Times, How I Made It. Was it an article? Is it a story? Lisa?
Yeah, there is a series of articles that they do on How I Made It, and it's a business owner that talks through, so the trials and tribulations of starting the business, but also the good things about the business. And well, I find them all very, very inspiring, and we're lucky enough to have some of these Times How I Made It people as our clients as well. So I think, well, I find them very inspiring. And then I love the Radio 4 program Gap Finders, and it talks to an entrepreneur about the business. It's essentially the same thing, but obviously not written, it's audio. But yeah, I like both of those things. I
think that's the key thing, is finding, if you're not sure of what your goals are, maybe you are inspired by somebody else. I'm a bit of a Pinterest person. I absolutely love Pinterest. It's my mood board. And even though numbers make a lot of sense to me, the images that Pinterest gives me that sort of freedom to create some goals. And it's not necessarily having that car, but it's the lifestyle that comes with it. Or it might not be, owning a yacht, because that would be the worst purchase ever. But it's the lifestyle that comes with it. And that's what motivates me. So it's finding your inspiration and thinking about that in terms of what your goal is. And at some point, just being able to write that one thing down, that one goal, that big, hairy, audacious goal. But remind yourself also, you're already doing brilliantly. You've got this far. You're running a business. You're doing what 60% of employees wish they could do. Most employees, majority of employees, 60%, the stats say, they wish that they could run a business. So you're already doing that. You're one step ahead. And if you've made it through your first 3-5 years, you're already ahead of many other people as well, because 50% of businesses are deemed to fail in the first 3 years. So keep doing what you're doing and just think about that growth and what else you want to achieve in your goals. But the key thing is also meeting like-minded people. I met Lisa many years ago at sort of networking groups, and many of my friends, associates, colleagues, clients, being around like-minded people has really helped to inspire and motivate my ideas and sort of galvanize my motivation for goals. Somebody else might have planted a seed that I didn't even think was possible. So just surround yourself with people, read things, and just remind yourself you're already doing really, really well. But ask yourself, what am I doing it for?
And I think Faye as well, talking about, look, Faye and I met through networking probably like 15 years ago or something like that. But when at that stage, I was in a really very male-dominated environment, and it would have been very easy to network within my industry. But actually, going outside of my industry and meeting people who are from all walks of life with all sorts of different businesses and different sizes actually I think was more valuable than just looking at how people have done it in my industry and what success already looked like in my industry. I think it's helped me to think of what could my version of success be that's different in a way.
Asking yourself what's possible, because we hold ourselves back through fear or many things because we think, oh, it's not possible. But I also go back to that times 25 figure. Start thinking 25 times bigger, 10 times bigger. I mean, there's a million books on the shelves out there that have got a theory of how you could, you know, sort of motivate and inspire yourself to achieve more. But just by thinking that little bit bigger, that's what the whole point of big, hairy, audacious goal is working towards something that's achievable, but it's going to take some going, and you're going to need some guts and oomph to do it.
Yeah,
but it's exciting.
My business coach, Brett, he told me that my big, hairy, audacious goal should feel 5% achievable.
Yeah.
And we've set some very big targets. And what's lovely is I think that change in mindset shifts me to do a little bit more each week, each month, each year, and it actually builds up to a big, big difference as well. So yeah,
and that's the beauty of working with a coach, because a coach is going to drive you to think a little bit bigger than what you may have done. You certainly probably wouldn't have started out on your own thinking, 5% is is a benchmark. For somebody else, that's 50%. But it's just about working with somebody else or working with like-minded people and just collaborating. Just gets you to think bigger, and coming on these sorts of things and just exploring what's possible. It just gets your mind thinking, what you need to do next. So
another way to come from a goal is to think about what is it that you actually need. And I know we keep referring to this 25 times, but I think some people will underestimate what they need. So I've got a lovely example for you here. Oh no, my little picture's gone. My picture's gone. I'll have to describe it to you. So what was on here about 5 minutes ago was a lovely picture of a client's cash flow. And this lady runs her own business. She's in her 40s, and she has an element of shortfall. So I think from memory, the shortfall was kicking in around 85. So she had enough money from 60 to 85, but after 85, she was in the red, and we needed to sort that out. This lady either needed £391,000 from the sale of her business, or somewhere else that money could come from to close that gap, or she needed between now and then to do £12,000 a year. So at the beginning, when we looked at this goal, she felt really confident that her business could sell for 400,000. I think she felt that the number was more like between 1 and 2 million eventually, if things went well, which we'll come to again in today's session, or we needed to do the 12. So we set off slow, and we started doing £500 a month into a pension. And with her accountant, they worked back the numbers, like what does the business need to do for me to be able to be paying £1,000 a month into the pension? And we've got there now. So if she doesn't sell the business, or she doesn't inherit a lump sum, or whatever doesn't happen, we're on track to achieve those goals. If she then does sell the business, either she's going to have more money in excess to be able to help her family out, or she's going to be able to retire earlier as well. So we're taking this double-pronged approach with her. And I like that way of planning. It feels really safe, but it also feels that the selling of the business is the cherry on the top, rather than it has to happen against all odds. I hope this is what have happened to all my little pictures as we go.
I'm just going to say, a lot of people do presume that they put a figure on, they're going to sell a business for a certain amount, and it's just wishful thinking, or I'm going to get an inheritance, and they're sort of passing that liability, that kind of that future wealth, assume it's going to come later, but there's not actually a plan, or the kind of, it's just a sort of a bit of this is what they're assuming, and the fear of them saving monthly or annually that amount feels too big. Whereas just even starting small, like you said, 100 quid, 150, 200 pound, just keep rising up till you get to that level. But ultimately really, really planning to what's the reality of selling your business for that value? Is that just something you've thought would be a great idea, or what's the reality behind it? Anyway, we're going to come to that.
Yeah. Another way that I thought about it with a client recently, she ran like a marketing PR agency, and the value of a client to her annually was the same price of the same as what she needed to be saving and investing every year. So like, right, you need to go and find one client to run your costs of the business every year. You need one client to pay you, well, two clients for her it was, to pay you the right amount for you to live the life that you want now, and then one client for the future you to be saving towards your retirement. And she really liked that way of
that's really motivating to do that.
Yeah. So Faye, how can we make our life easier?
So I've got this model that I call the gold, go for gold model. Hopefully you can read what's on the screen, but just thinking about it, and I love an acronym, and when you're a coach, you just love an acronym. So I'm always forever creating one. So GROW is, if you're planning on growth, you've got to spend some time sort of putting in the plans. So, sitting down, strategizing, planning, working with your accountant, your IFA. Look at your business plan. Just because you've been in business for 20 years doesn't mean you should never look back at your business plan. The business plan is not just because you're going to go and get a bank loan and the sort of the old school days. Your business plan is for you to make sure you're on track and you're doing all the things you want to do. So if you want that growth, write it down, plan it, think about what it is you need to focus on. Is it staff? Is it increasing? Is it getting a bigger premises? Is it investing in software? Is it investing in technology? What do you need to do to scale and grow that business? And when, of course, we are talking about growth, because we're talking about the potential to sell a business later or have enough income from that business to ensure you've got the life you want at the end of, in the future, so you can get that goal. So think about, what do you need to do? I mean, is it increasing sales? Is it, as I said, increasing staff? So therefore sales to staff members, so therefore your margins improve. So spend some time, write that down, jot it down now if some things come to mind. I'm a great jotter, so if anything comes to mind, just scribble it. And then think about organising. If things aren't quite working out and you haven't got the infrastructures in place, now's the time to put in systems. Your systems, your processes, they are the things that help you scale. If things don't work, they're a bit smudgy, they're a bit kind of rough around the edges. If your onboarding process is a little bit higgledy-piggledy, iron those out. Absolutely make those efficient, make those smooth, make that process simple, so you can sort of, and take regular actions to make sure you do it. A very simple thing: spend 2 hours a week working on your business, sit, organize, put in place, and every time you do that, think about a new process or an improved process. Now, as I've always said, it's like getting the spanner. Something might work really well, but after a while, you shake it a bit, the sort of the nuts and bolts start loosening up. So you just get that spanner, keep tightening things up, and allowing yourself for scale and growth. The next one is learn. Learn from your mistakes, but learn from other people. Motivate yourself by others, but look where you can improve your skills. There's no point resting on your laurels and saying, well, that's it, I can do what I do it really well. There is so much more you can learn. If you're not great at your finances, learn about your finances. If you're not great at your IT, well, that's probably not the same. I don't want to learn about my IT, but what do you need? What skills do you need to scale and grow your business to get to where you want to get to? What might you need to learn? So invest in yourself, invest in some tools and resources. And then this comes to that digging deep. It's being really honest with yourself and being kind of really, really actively looking at your debt, for example, looking at your assets. A lot of people just sort of hide under the covers and go, yeah, I've got a pension somewhere. Oh, I've got about 10 grand's worth of credit card debt. Oh, I've got a bounce back loan. I don't know how much is left. Really dig deep and just look at what is the reality? What's the true picture? Get your shoulders back, get the big girl pants on, and just embrace the reality, but also really look at your strengths and weaknesses in businesses. What is it you're doing well? What is it you're doing badly? Spend some time reflecting on all your goals, all the things you want to do. Ask yourself some really, really tough questions, because without doing that, work with somebody who will ask you really tough questions. Without asking yourself or pushing yourself to that limit and being truly honest with the reality, these goals will end up being on a whim rather than planned and structured. So make them real. So think about this as just a simple formula as what needs to happen to get you in the right mindset for growth and to go for growth.
Thank you.
So with that, it takes me to, are you doing all the stuff yourself? Again, if you want to grow a business, there's no point in you working 24/7, working 7 days a week, working through the evenings, because when you do, if you were to sell a business or exit later, but particularly selling a business, you'll find that no one really wants to buy a business where the owner manager is doing all the work, is doing absolutely everything. There can be that can minimize some of the value to the business. But so ask yourself the questions, what are the things that you can do, delegate or outsource? Do might be the things that you can do yourself where your perhaps highly valued skills are necessary, but talking more about delegating and outsourcing, get somebody else to do the stuff that either you're not good at, that gives you financial value. So can you pay staff, anyone else to do something that would be cheaper than you doing it? Can you pay people or get someone else to do something that has better skills than you? Perhaps they can use the time more productively. You might spend 5 hours trying to fix your IT system, which is what I would do, where somebody might do it with their eyes closed in an hour if there was something that needed to be doing. So think about your skill value versus your time and effort. And then the mental effort of doing so. It's nothing more frustrating when you don't know what you're doing and you're trying to do something because you're trying to do it all yourself. It's just, from a mental point of view, it's just diminishing in terms of how motivating you're feeling. So if you know it's a mental strain, delegate it, get somebody else to do it. If you can have more financial value by selling services to your clients at the higher end, but yet you can get somebody else to do your admin, for example, absolutely do that. And if you've got some people that have got the skills that you haven't got, do think about delegating. So just in your business again now, thinking about creating some value, some growth, where you can generate more, whether that's more sales or whatever it might be. What can you delegate or outsource to take that burden off yourself so you can focus on growing the business? Have a jot down and think about anything that comes to mind.
An exercise that I did, Faye, was just actually write down all the tasks that I did in a week. And I was actually quite surprised at all the little things that I was actually doing that I could delegate. And the tasks that you really dread, you should do them first thing in the morning, but you probably still haven't done them at the end of the evening. Those ones I think are a great thing to outsource to somebody else.
As you said, and I've done that before, we just do it in columns. So if you do a list of all your tasks, do the first list and then create some columns. What I need to do, what someone else could do, what I don't want to do. And then literally split them up and go, and then you've got a real clear visual of what it is you do or don't want to do. And then you go, right, brilliant, that column's done, outsource.
Okay, so we've talked about the things going well, the big goals, but underneath all these big goals, there needs to be a safety net. And that safety net really is to make sure that you and the business don't fall too far if things just don't go to plan. So the things to ask yourself is, what would happen if you died or you couldn't work anymore? And don't shy away from really thinking about these questions. What would actually happen if you died? What would happen tomorrow to your business if you weren't there or you couldn't do those client meetings? What would your family need? Firstly, partners, kids, family, anyone that's reliant upon you. But also, what would your business need if you weren't there? And next, do you have a will in place? And does it clearly state the business aspect of your life and the personal aspect of your life as well? And then what would actually happen to your work shares? And are they covered in the will? And whose hands would they end up in? And are they the right hands? Oh no, my little, I'm cursed. My little visual hasn't worked here. But Faye, I don't know if you can remember the numbers, but anyway, I went to riskreality.co.uk. Let me just stop sharing, see if I can get, if I don't have this in share mode, does it come up?
All the numbers up in the meantime.
Let me just, I've got it here. If I can put it in, I wonder if I could, this is me testing my IT skills. Can I put it in the chat? No. Okay, let me copy this and I'll just put it on a Word doc. Let me see. I think it's nice to see this. Sorry, everybody, bear with me. Always like a technical bother. Actually, I can share it this way. Let me just see, does this work? If I just share the unpresenter mode, can you see that?
Perfect.
My Canva. Yeah, so I went onto this website, 𝗪𝗡𝗏reality.co.uk, and it's a tool that LV, the insurer, has done. And I put in my age, so 44, do I smoke? No. And what age do I want to retire? And I put 65. And these are my statistics. So you can run your own and see what they come out as. But the one that shocked me the most was there's a 30% chance of me being unable to work for 2 months or more in my business. And that could be really life-changing for me, but also for the business, especially while we're at this period of growth. The simple solution to that is to insure yourself against that risk, and it's really not expensive to do. I think most people think, oh, the chance of dying, I'll get some life cover, that's cheap, that's sorted. But actually the biggest stats are, what if you get seriously ill, or what if you can't work, get a critical illness. So let me just go back to the presenting mode so you don't see all my notes. Proof it was there originally. So this is something that I'm currently sorting out for myself, but also clients seem to love. So if I died, my shares, the business, would go to my husband. He doesn't have a financial bone in his body, so I don't think he'd be very good at running this business. Neither would I be good at managing his business, because he's a creative. But he does not want shares in my company, and I'm sure my colleagues do not want him to have the shares. What he does want, though, is probably money. The company is in the situation where it does really want those shares, but it needs money to buy those shares, and so actually is quite powerless. There's a really good case study if you ever want to look it up, but there's that coffee shop that used to always be my favourite, AMT. It was run by 2 brothers, and one of them sadly died, and they hadn't got something like this in place. And to cut a very long story short, after lots of rowing between the family, it ended up being the demise of the company. But yeah, AMT coffee shops. So this is a cross-option agreement. So here in the top right, I die, a life cover pays out, and the money goes into the company tax-free. So the company now has money, and my husband has the shares. And so you put into write up this cross-option agreement. Either a solicitor can do it, or some insurance providers will have templates that might be sufficient as well. And the cross-option agreement usually says if either of us wants the exchange to happen, it has to happen. If both of you don't want the exchange to happen, then it doesn't have to happen. So let's say my husband really does want to work in the company, but the directors of the company decide that that's not what's going to happen. He has to hand over the shares, and they have to hand over the money. And so he would end up with the money, the company would end up with the shares, and life for the company can go on, which I think is very important. And then I've just got 4 insurances that people always mix up. So the first one is executive income protection and personal income protection. It's what it sounds like. So executive income protection is where the company pays for it, You can cover national insurance, gross salary, pension payments, and dividends as well. And it's subject to tax and national insurance if I paid it out. So let's say I'm sick, the company receives the income protection payment into the company. Let's say it's £10,000 a month. That £10,000 a month comes to me as an individual into my personal bank account after tax and NI. A personal income protection is where I pay for the policy myself, and those premiums are being paid for after tax and NI has occurred. The benefits currently aren't subject to tax, so the insurer would pay me out directly, and then the benefits are paid to me directly. There's pros and cons of each, but it's worthwhile weighing it up with an expert. We can do this kind of insurance in-house, but at the moment we tend to outsource it because there's a lady called Naomi who is much more of an expert at this side of things than I am. The other is a key person cover. So in that situation with the cross-option agreement, if a person is not dead, but a really important person to your company is critically ill, let's say, and can no longer work, you can insure against that. So I was at a talk with a lady who, again, she ran a marketing company, and very early on in her business, she got cancer, and a critical illness policy of £250,000 paid out into the company, and that kept her business afloat and able to recruit a replacement for her while she concentrated on getting better, and it was just a life changer for her. So yes, you can use the money to replace staff or cover lost profits so that you're keeping the business afloat. And there's some great calculators online by the insurers that will help you work out how much key person cover you need to attribute to each key member of staff. And I think it's very good in businesses where, let's say, there is a salesperson and then there's the doer of the business making the product, let's say. If the salesperson goes, the company can't continue because the doer has got no work to do. If the doer goes because they're sick, the salesperson can close as many deals as they want, but there's not going to be anyone to do the job. So it's especially where there's a skill split, I think it's extra important. And then relevant life cover. So relevant life cover is type of insurance, like if you were employed and you got your death in service, and it's written in trust, which is the relevant life bit. And this means the company is allowed to pay for it, but rather than with the cross-option agreement, the life insurance going into the company, the life insurance goes into a trust, and the trust says, pay this out to whoever it may be, your spouse, your children, relatives. And so the money then goes tax-free to your family member or the person that you want to have the money go to without any tax. And premiums are often tax deductible for the employer as well. So those two are really important to know, but also the income protection to protect against that downside risk. So I'll hand back to you, Faye, after the doom and gloom of other ways to reward yourself.
I'm just going to also just add another type of insurance is the shareholder agreement. The amount of businesses, and one of the things I kept thinking about throughout you speaking then was about getting real. About some of these feel like, oh God, you know, kind of gloomy thoughts about what's going to happen on death or conflict or all of these things. And it is sometimes hard to put in place those future-proofing things because you always think that you're immortal and nothing's going to happen. But simple things like a shareholders agreement, having that in place when you start a business and there's more than one of you as a shareholder in the business, are absolutely fundamental. And, you know, getting real about all these things, as boring and as laborious as they might seem, they are absolute deal breakers because the amount of businesses we've tried to untangle or help later on because they didn't have a shareholders agreement, or there's so much conflict on death, divorce, pregnancy, whatever it might be, it just aligns with all of these things that you're talking about. And those businesses that I've seen over the years that are the most successful are all the ones that have done all the sensible stuff. Yeah. So just to a real wake-up call there. Anyway, other ways to reward yourself. I'm sure if you're a director, owner of your business, whether there's one or two or however many of you, which is slightly different from, I'm not talking about sole traders now, I'm talking about sort of if you're a director owner, so owner-managed company, you're probably paying yourself a small salary and dividends because that's really the most tax-efficient way to do so. You'll have probably, by now, if you've got an accountant, had noticed that you're going to be paying more national insurance this year because the national insurance threshold came down for what you pay, but also the national insurance rate has gone up. So if you are a one-man band in a company, it's going to hurt and a little bit more. You're going to pay a bit more NI. It's still the most tax-efficient thing to do compared to paying your dividends after your corporation tax. But I just wanted to share a couple of other little things to think about that may be crucial as well as part of your remuneration strategy. One of them is pensions. I think pensions is one of the most fundamentally obvious and brilliant pieces of a way to pay yourself from a limited company. What written into trust means is simply that if your company can pay your pension contributions, the company's not going to benefit from the pension. You are. It's written into trust that it's your pension as if it was there's a personal pension. But the benefit of the company paying the pension contribution is simply that you're getting corporation tax relief. You're not having to take your money out and paying a dividend tax to then pay for it personally, or paying higher rates of NIC if you're taking a salary, depending on the structure of your business. But a pension is simply a tax-free benefit. Company pays your pension contribution, provided you are doing it for the best interest of the business. So if you were only making, if it's a very small business and you were just funding a pension, there are some sort of grey rules. But fundamentally, a great benefit scheme would be a pension. As I said, it's an allowable expense, and the company and you as well can pay up to 240 grand if you haven't done so before. So if you're sitting here saying, you've got 240 grand extra in your company, and you haven't used up your pension allowances over the year and you meet the criteria, you can use your last 3 carry forward amounts of pension allowance. And it's currently £60,000 a year, but it gets diminished to 10 grand based on the level of income you've got. So you could be paying up to 240 grand into your pension today you haven't done before and get all that corporation tax relief. So it's a brilliant benefit. There's no tax and national insurance on that being a benefit. I'd say it's a pretty obvious one, but so many people don't realise that they get their relief.
I think it's something like 26% of people who are self-employed or own their own business have a pension.
Wow.
So it's very, very, very low. And I think the written into trust bit also is benefit, because if the business, something were to happen to the business, your assets aren't necessarily completely protected, are they? But assets held within a pension are not technically yours because they're in the trust, and therefore they can't be raided as long as you haven't purposefully denied the company. The pension is protected on bankruptcy as well.
I mean, there's lots of complexities around pension, but 26% is almost a ghastly figure. But I'm not surprised, because the amount of people I talk to are well aware of their pension and what they can and can't do generally well aware. But they're kind of going, oh, I'll do it later. Oh, I haven't got the money for a pension now. Oh, yeah, I'll start to think about later. And it goes back to that thing I was saying at the beginning, is that people just assume they'll sell their business for X amount and it'll be all right in the end. And actually, I think pension should really be part of, an expense like marketing, like anything else. It's and some people still have the belief that bricks and mortar is their pension, but there's so much more to pensions now. Some other little tax benefits though that you might have not be doing in your limited company, and this is the most, it's small, but it's the most obvious one. If your mobile phone is in your personal name and your company reimburses you, it's technically partially a benefit in kind subject to NI if they reimburse you the whole 100% and the company claims it. They can claim the business element of it, but it's a bit of a faff. Simple. Make sure the company has got the contract set up, the mobile phone, with your mobile phone provider. Also for VAT purposes, if you're a VAT registered business, then you can claim the whole of the VAT, because if you've still got the contract in your personal name, it's an old legacy contract, you can't claim the VAT and the company can't pay the full amount. You're probably doing it that unwittingly, but HMRC can be quite aggressive on that and go back. So just call your mobile phone provider, ask them to put the contract into your company name, even if they won't give you a business contract. So sometimes you might be mid-contract, you might be another 2 years in, so you can't change the contract. But when you do renew, put a business contract into the company. But see if they'll just change the invoice and so that it's addressed to the company and it can come out of the company bank account. The other one is mileage allowance. So are you claiming your miles? So if you haven't got a company car, you can claim the miles that you are using in your own personal car. That's 45 pence a mile for the first 10,000 miles. So many people don't bother. They're like, oh, I only did 100 miles. But you've probably done a lot more than you think. Simply keep a mileage log. There's loads of apps that you can use. When you get in the car, tap it and it will measure your miles. HMRC do expect to see some level of sort of a schedule of your mileage rather than just, oh, I did 5,000 miles. They would expect to see a genuine kind of, what was it at the beginning? What was your miles on your dashboard before the beginning of the year and then what was at the end? How much of that is business? There's got to be a sort of sense check. But the business can reimburse you for that mileage, totally tax-free. And as I said, after 10,000 miles, it then drops to 25p. But it's a tax-free, it's a tax deduction in the company, it's a tax-free amount for you. So, it's an absolute no-brainer. And the reason parking is there is if you are using your own car and parking, that is a travel expense and not a motor expense. So although most people know that if you haven't got a company car, you can't claim your car tax and all the petrol running costs for a car. But parking is, however, a travel cost, as is a toll cost. If you're having to go somewhere, the purpose of your work to see a client, make sure things like parking. Now, with things like Ringo apps and all of those, you can actually download those reports. So a little one, but I thought I'd throw that in there. Trivial benefits gets forgotten. The trivial benefits allow you to pay employees up to £50 per month for just a goodwill, thank you, a pizza, beers on a Friday, bunch of flowers on their birthday. It can't be a reward for good service, but it can be it's Friday, the sun is shining, let's go and have a drink in the pub. And as long as that bill per head is £50 or less than £50 per person, you can claim that as a deduction. And it's really important that you don't confuse that with entertaining. So when you're writing up your own accounts, if you've got employees, if you are treating them up to the £50, if it's £51, you can't claim it. It has to be £50 up to £50 per head. Actually mark that as a trivial benefit in your records so that your accountant knows that this is not an entertaining cost, this is a trivial benefit. As I said, it might be flowers if somebody's birthday cake, it might be. So it's got to be something that you don't necessarily do. It's not contractual. It's something you've just done as a business owner. But what you can also do as a business owner is do the same for yourself. As a director, you can send yourself a bunch of flowers or give yourself a small Christmas token if that's what you do for the rest of your team. As an owner-managed director business on your own, if you were rigidly allowing yourself the £300 a year, I think that could be questionable to HMRC. The allowance is there, but there's also the argument that when you're on a small salary, you're getting paid a director's salary, you're not an employee. So there is some conflict in this, and there isn't always a lot of guidance. But if you're giving your employees a bunch of flowers on their birthday, why not buy one? Buy some for yourself. But up to £300 a year is relevant for directors, whereas I said it's £50 per month for employees.
So Faye, so as a director, can I have one thing for 300 rather than six lots of 50?
No, they're separated. They're still captured.
Not exciting then.
No, I mean, it's typical would be a pizza, a drink after work, a bunch of flowers. Again, it's not a reward for good service. It's just there you go. And also it's not something you continually do every year, because you could argue then that becomes contractual if you always do that. But yeah, if you're giving your staff some flowers, give them to yourself too for your birthday. And likewise, if you buy everyone a bottle of wine at Christmas, make sure you've got one too. But the point is it's actually mark it as a trivial benefit in your accounting records. Do not put it under entertaining, because it will get mixed and it'll get assumed it's just an entertaining. And therefore you don't get the tax relief. That's what's important there. It's not a taxable benefit, hence it doesn't go on a P11D for employees. Electric cars. Electric vehicles have, since they've started, been a really tax efficient way of having a car through the business, the company can own the electric car. However, only buy an electric car if you actually want one. Never do something because it gives you tax relief, because the tax relief will be insignificant by comparison to your joy. So if you're going to buy a brand new electric car, put it through the company. If you're going to buy a second-hand electric car that's several years old, 10 years old, probably don't put it through the company. If you're about to buy yourself a Range Rover that's non-electric, that's high CO2, no, definitely don't put it through the company. But an electric car, if you wanted to buy an electric car, the company should be buying that for you. And that could be a lease, or it could be sort of a balloon, or however you want to structure it as a sort of finance agreement. The same thing works as a salary sacrifice for your staff. You could also offer electric cars as part of a salary sacrifice scheme to your team, tax efficient. There's a small benefit in kind in the value of the electric car, but it's still a tax efficient benefit. So if you think about, if you're adding all these little things up, they do make a difference. There could be quite a few grand's worth of value each year. And then finally, working from home, the amount of people that miss any working from home allowance when they're a limited company if they run their business from home. Of course, if you have an office and you're paying rent in your office, you wouldn't really be claiming a working from home allowance. You have to be quite careful with this when you're a company that you don't overclaim. HMRC's guidance is about £312 a year if you are working full time in your business. But as long as you do a detailed working for how much time you are using at home, you don't need a rental agreement, but you may need to put something in your tax return, but it depends on how you structured it. But just make sure that you are accounting for it every year, and there is some home allowance if you do work from home in your accounts. So they're the general ones. There's things like cycle to work scheme and all sorts of things like that as well, but I haven't really mentioned those.
So moving on to exiting. So everything's gone well. There's been no need for your safety net. Everything's gone swimmingly. These are the ones that I thought, Faye, that I came across I've come across in our client base recently. So yeah, I'll let you do the explanation.
It goes back to the big hairy audacious goal. Maybe you've got one for you personally, maybe you've got one for the company. But how do you envisage getting out? Are you just running your business now for a bit of extra pocket money, or are you seriously running a business that you want to grow and scale? Not saying that you're not serious if you're running it for pocket money, but it's just a different intention. But if you are scaling up to build business value, ask yourself a question. What's your exit strategy? I mean, that phrase is bandied around quite a lot, but how are you going to get out? What are you thinking of the end of the line, whatever that is? Maybe you haven't thought about it. If you haven't, start thinking about it. If you've got a company that's got value to it and you've built it up and you've got a team and you've built up those processes, those infrastructures, you've delegated things, you've got, it's working well, it's an efficient business, chances are it's saleable. So you might think simply about a sale. If it's going great guns, you might be thinking of an IPO, which is effectively a sale where you're listing it. I always think about Kirsty and Phil, they love it or list it. But maybe you're thinking about listing your business if you're getting to that right scale. And in effect, that is a sale. You might be thinking about selling to venture capitalists to raise some funds. That's happening a lot in accounting and law professions right now. There's a lot of investors coming in and buying up a lot of professional services firms or part of. It may be something like a management buyout. So wherefore you've got the management team, maybe you've built up a team of managers or juniors that become managers. They've been with you for a while. They may be an option for them to buy you out, get you out of the business, and you can put that in place. You're actually building that up, cementing that into their mindset as well. So you can put some structures in place. Sometimes happens in legal firms as well. So you get sort of associates, and you get they might want to sort of buy out the owners. And there are multiple ways that selling and management buyouts can be done as well. Most of the time, the management buyout, the managers don't have shares, but they'll be buying the shares of the owner. But in a sale or a sort of a merger or something, there also might be the company could buy back your shares, for example, for a premium. Or you might just simply want to go through a formal liquidation, just call it a day, leave it at that and just walk away. Have you built up enough liquid assets in the company, so that a formal liquidation means you get some money out at a lower rate of tax, for example. Maybe that's your exit strategy. So you're building up the funds, and then when you do, you're not paying dividend taxes to take that money out. Ask yourself, have you thought, so the question is, what's your preference? Have you thought about what you might do? And what's your instinct? It'd be really lovely to see if anyone puts it in the chat as what they think they might plan to do, if they know exactly what they're doing already. But think about scaling that business and the opportunities that you might have, and how to get out of the business with some value. A liquidation means you'll get whatever you've built up in it, but no one's buying it from you. Therefore, you're not necessarily getting any more value. But a sale, of course, or a management buyout, you're getting funds, you're getting a value for your business.
I've had some chats sent directly to me, so if you don't want to tell everyone, you can just drop it down and send it to me. But most people are saying selling is their
yeah. I mean, to build a business to sale, I think it's the most obvious one. People often don't know about management buyouts, or building up a team that are going to buy the business from you. It's about putting that in place. So selling a business. If we move on to the next screen, I'll just tell you the things that you should be thinking about now. So when you are thinking about selling your business, and in one way or another, so not so much as a liquidation would be relevant as well. Ask yourself, what's the tax, or find out what is the tax implication. I think any decision that you make, you don't want to sort of find yourself running down the street and moving forward with a sale without seeking professional advice. You could be paying way more tax than you need to be. Whereas timing of when you sell the business, how you sell the business, is it a share buyback? Is it a venture capitalist coming along? Is it an IPO? What kind of sale? Is it a sale just to another company? What are the tax implications? Are you selling your shares? Is a different tax implication. So is the company buying your shares back? Because there's certain things you also need to do with HMRC. So understanding what the tax implications are for you. The next point was, how much has the company got any debt? Really consider that. A bounce back loan is always, it's still on the balance sheet. People forget about it. It was 2.5%. You've got all these extended them to 10 years and beyond. And a lot of people have still got bounce back loans. So of course, it's any debt in the company is going to diminish the value of that company. So when somebody's coming along to value it, they're going to be looking at the company debt. So settling debt, because it also does give the illusion that the company has needed finance. So clearing as much debt as you possibly can is always really helpful. But just knowing what that company debt is. I mean, are you owed loads of money by your customers? Have you got a 6-week framework that they're paying you? Or are they paying you within 6 days or 2 weeks? So how do you manage your funds, and how do you manage your debt? Is there bank loans, for example? What would be the issue if you sold a business? How would the bank loan be dealt with?
And Faye, just to put you on the spot, so Tom's just said in the chat that he's got a limited company with buy-to-lets inside, and his intention is to put younger family members on the business as he gets older. Are there any tax consequences of adding family members?
Yeah, absolutely, especially because it's an investment company, so it's not a trading company. So because it owns buy-to-let property, it's not a qualifying trading company, like let's call it marketing or business or even property development. So you're gifting, you don't therefore qualify for any entrepreneurs relief, which is now business asset disposal relief. So you will be paying, I mean, the capital gains tax rates have increased, but you will fundamentally, on the disposal of your shares, your company's value is effectively the net value of all your properties in that portfolio. So if you've got 100 shares and that's worth £1 million, I will do maths quickly, because I have to remember what I've said. 100 shares, it's worth £1 million, so, or whatever. If you were to give them 10%, then effectively you're disposing of an asset which is 10% of your £1 million worth of value. So you would pay capital gains tax on that basis, because it's a deemed transfer to a connected, well, it is a transfer, but it's to a connected party. So yeah, for example, a buy-to-let portfolio is very different from a trading structure. So you do absolutely need to take advice. And likely in that instance, you've got a lot of company debt. You've probably got mortgages attached to the properties. You might have other investors as well. So you would definitely think about that. But that's not usually a buy-to-let. You would be looking at a sale. You'd probably be selling the properties off because of the implications around stamp duty. Depends on all your buyers as well. But yeah, you'd look at the capital gain on the value of what the percentage that you're giving away to kids. Also, just add, if they're under 18 and they're generating income from those shares later on, so dividends, they're still subject to tax on you because you've given away your asset. Even if it's grandchildren, but if it's your own children, it's still taxable on you if it's more than 100 quid. So a lot of people think giving assets to kids minimises the income tax on them. It doesn't. So just think about the reason you're doing it.
Thanks.
That answers the question.
I'll just speed on because we haven't got long left to finish on time. So the last bit is then about making this money last. So this assumes everything's gone well, you've made the sale, and how do we put a financial plan in place to make sure that this money then lasts you for a long time? So the first one is understanding your annual return need. So what do your investments need to grow at to make sure that you can continue to afford this lifestyle? A big one, honestly, I feel like in retirement, I'm continually telling clients, don't underspend. You definitely need to be tax efficient. If there's excess money, you need to gift earlier rather than later. I tend to see as a real sweeping statement, once people get past 80, they feel too nervous to gift. So really gift when you are feeling confident in your financial plan. Think about whose name you're holding the assets in. Think about your income fluctuations over time. Most of the time, people spend a lot of money in early retirement, not so much in the middle. And then sadly, the last decade of somebody's life could be very expensive. Thinking about charitable donations obviously can help with your tax, but also accumulating assets that have different taxes. So most people accumulate for retirement in assets that are income taxable. So your state pension, your personal pension, investment properties, and these are all just stacking on top of each other and accumulating a lot of income tax. Whereas, are there other things that you could accumulate? So investments that are in ISAs are obviously tax-free. We've got lots of ISA millionaires in our client portfolio who have just done the allowance every year. And that means any money we take from those ISAs are tax-free. But also investments in a general investment account are subject to capital gains tax, which at least currently is a lower rate of tax as well. So I think it's about having different types of assets with different tax. And then obviously you can't see my next slide. Let me just quickly stop sharing because I do want to show you this one. I don't know why that's working like that, but anyway, it is. It's very frustrating. Okay, what I was going to show you, because it's not there, it's only in the small section at the bottom. Let me see, probably too small to see. But what the thing I'm trying to show you is bottom middle. Let me show, here we go. Bottom middle just here. It's probably too small, but I'll describe it. So on the bottom, we've got a graph where a client sold his business. We always project forward a low rate of return. So at 4%, he's going to start running out of money in his late 70s. If we got an investment return of 7%, he's going to start running out of money in his late 80s. He needs 7.19% return to achieve his goal. Now, he's quite an aggressive investor. His portfolios achieve more than that on average, but we can't necessarily rely on it. But I was still happy for him to retire and not work again, because if we look on the next graph here, which you can see now, can we go back to that one? Does it work? No, it doesn't show up. Anyway, to this one, this is his asset schedule. So you can see when he starts to run out of money in his early 90s, this purple is his assets that he's not spent, so his non-liquid assets. So for him, these are rental properties. So still happy for him to retire, spend down his savings, spend down his pensions, because we can always fall back on these assets. They're non-liquid assets that we have. So understanding the order at which you will rely on assets is really important when deciding to take the leap. And then I'm just going to see if I bet my next slide won't show up. So can you see that one, Faye, the next one? This is something that I see so often. So this is a very young client in their mid-40s, sold their business, got more money than they're ever going to need, but it's a lifestyle that they're really, really not used to. And they at the moment are in touch with me a lot about what they can and can't spend. And the answer is always, please just spend. Because if you project forward at they're used to not spending very much. We project forward, they've got 24 million at the age of 100. So these people really, really do need to spend. And my job as their advisor is to give them confidence in being able to spend and to make that change in mindset. But for this couple, they need to spend an extra £175,000 a year to even start worrying about running out of money. So I'm just showing you different extremes. We've got the lady who needed 300. Not all clients will have 24 million at retirement, but I just wanted to show you different extremes.
Lovely position to be in, but also a lovely position for HMRC to be in. We think about all that inheritance tax.
Exactly. And well, you may as well have fun if you can.
Like I was talking about earlier, it doesn't seem so stupid for them.
So going back now, I'll present it now, but really the next bit we'll be finishing up now, but is to think about your biggest takeaway. So there's no point turning up today if let me just see if I've got it right, if you aren't going to do anything about it. So what was the biggest thing that you took away from today? What are the 2 or 3 actions that you're actually going to do to make this hour that you've invested worthwhile? And then how I can help. So you can follow me on Instagram. We try and do Instagram posts daily, but it usually happens every other day or ish. But to give you top money tips. So that is the idea behind it being, if you learn something new every day, then you're going to build a wealth of knowledge over time. We do the quarterly newsletter that you can sign up to either at 𝗪𝗪𝗏 Wealth or Miss Lolly. And that's us keeping you on top of everything you need to know in the world of money. Or you could book a financial diagnosis session. They cost between £350 and £500, where I build you that lifetime cash flow model. So this is an example of one, and you'll walk away knowing what you need to do every year to achieve your goals, whether you're on track or not, what you can afford to spend every year in retirement, the investment returns that you need, or the lump sum that you need to close your shortfall, which I think are all quite empowering for business owners. Faye, do you want to explain to people how you can help them?
Very simply, so as accountants, as a firm of accountants, of course, we do a lot of general practice, specialise in property as well as just, to be fair, I don't think we actually specialise so much anymore. We cover so many things as a coach. So please get in touch if you're looking for a good accountant, tax advisors, or if you feel like you need a bit of a kick up the bum and need a good coach. Yeah, please reach out to you.
The next session in this series, so 4, the third one, is going to be on Tuesday, the 16th of September. And we're going to meet Heather, who is gorgeous. She's probably the brightest person I know. And she's an outsourced finance director, and she's looked after so many businesses. There's probably nothing she hasn't seen. And at the moment, we're a little undecided about what we're going to talk about, because what she could talk about is just so huge. So if there's anything you specifically would love to know from a financial director, then let me know, and that can help shape the content. But put the 16th in your diary. We'll send out reminders closer to the time. And that was all. If anyone's still here, sorry we overran, but if you've got questions, we can stay for a few minutes and go through them. But thank you very much for coming along.
Thank you.